as these ripple effects begin to set in. Simeon Gutman is Morgan Stanley's retail analyst. Simeon, it's great to see you. I don't think you cover the toy makers. Welcome.
Thanks for having me. We have a little toy exposure through the end market, through Walmart's, Five Belows, et cetera.
True. So tell us, are they going to suffer?
I mean, if they stop ordering now, then they won't have the right assortment that they were planning all year to have by the second half of the year. So that's true. And in both of these companies, you're trying to get different product. Think about the dollar stores. Think about what Five Below brings. They're bringing value to low price items. They're merchandising those items to their own specifications to align with fads, holidays, movies, trend, whatever that is. That product should be on boats at some point soon. If it's not, then they're going to have to retool what they want to put on their shelf. There'll be toys, but it may not be the exact ones that they wanted.
Would you categorize them and kind of give us the run through? Who are the winners and who are the losers here, do you think?
So we started with auto parts, and keep in mind, this is multi-pronged. It's potential tariff, potential recession, and then what if we get neither or nor, and it's a cyclical risk-on type of environment. So we're trying to find the names that have the most applicability to any of those environments. Auto parts was the starting point, and by the way, we're trying to balance all of that with valuation. Auto parts, think about tariff, recession, very insulated, very defensive. If we have new car sales slowing, which is likely because of inflation, then we're going to have more used cars on the road. The age of those cars are going to go up, and consumers are going to have to spend more to keep up their old cars. That's a perfect scenario, and you can pass along tariff pricing. This sector loses if we have cyclical risk on, no tariff, no recession. It loses on a relative basis. That's the first one. I'll also highlight Ulta. This is using valuation a little more reasonable. The auto part names are a little more stretched. Ulta's coming off of a tougher 2024, easy comparisons. They set a low bar, and the valuation is a little bit more attractive relative to all of the separation that's happened in retail.
Well, you know, again, then you go through the discounter. I mean, you've got a lot of different companies on here, the home improvement, sporting goods, home furnishings, grocers, dollar stores. You mentioned Tractor Supply. So there's each one of these is kind of a different ballgame. I hate to put it exactly this way, but who do you think is worse positioned?
Well, if you have all day, we can go through all of them. Look, for right now, to us, the dollar stores are complex. Dollar stores have a path out once we get through this uncertain period. And fair enough, uncertainty creates opportunity, but you have to deal with potential tariff. Yes, we may not be at 145. I was listening to the quote earlier, but you're still going to have some form of tariff. The last time these lower priced businesses, they sell items at lower price. Last time we dealt with inflation through the COVID period, they're still adjusting to that. They've all had to break out of their dollar pricing architecture, and they've had to, we call it break the buck,
right.
Five Below into Five Beyond. These businesses didn't deal with that inflation so well. What's different this time is we probably won't have labor inflation the way we had post-COVID, but you're going to have pricing, which means you're going to have to show the customer a different price. They're going to have to get used to it. That lost share. Walmart, Target, Amazon picked up share during that time frame. So that's a tricky setup, although these businesses have a path post this tariff uncertainty.
Sure, and I thought it was very interesting, the Skechers buyout. I mean, it's a low share price. It's an opportunistic move. Why be under the glare of public markets? They clearly must feel somewhat more bullish about the business long term than they're thinking the market's giving them credit for right now. So I just wonder if we could see any others follow suit.
So I don't cover Skechers. That's in a different purview. But think about the applicability where a brand, a global brand, is being pursued because of potential expansion of distribution opportunity. You know, and I look back to my coverage. That was the first instinct. Where do we have brands? We don't have many. It's mostly retailers. But the closest we have is Williams-Sonoma. It's a furniture brand. It's trading at an extended multiple to its history, but not an extended multiple relative to the rest of retail. And that's a category that's going to be impacted by tariff, where there's going to be some disruption, but should have a lot of potential future value.